So, hi friends, a very good evening to all of you. Thank you for joining in on this special spaces on personal finance by GST Investments. I'm Aditya Kondawar. I'm the Chief Operating Officer for GST Investments, and I'll be a moderator and host for the evening. Before I tell you about the speakers, a quick intro to personal finance. Now, personal finance is something that covers everything from your savings to your asset allocation to the specific assets that you own under each of these asset classes, right? There's a very famous dialogue in the series Scam 1992 on Harshad Mehta, right? So he says that stock market is like a kua, it's like a well, and there's no bottom to it. And personal finance is also something like that. It's very deep. Like the name says, personal finance is extremely personal. And today, we are going to learn a lot from this amazing speaker lineup that we have today. So personal finance forms the foundation for your investing journey. If you don't have your personal finances in line, then it's certain that your investing journey is also going to be shaky and uncertain. Having said that, it gives me immense pleasure to introduce my five friends from whom we are going to learn a lot tonight. First up, we have Deepika Jaikishan. She is the co-founder and chief operating officer for Get Basis. It's a woman focused finance company. We have Shana Gulati, who's the editor of Film Medium, and she's a personal finance writer and enthusiast. I believe she has been quoted in a couple of places, Economic Times, Live Mint, etc. Then we have Larissa Fernand. She's the senior editor at Morningstar. Then we have Gurmeet, who's the co-founder and CEO of Complete Circle Capital. They basically help build their clients with long-term portfolios. We have Balaji in the end, Balaji Thutadri. He's the CFO of a leading edtech, and he's a personal finance writer and enthusiast. So first of all, I wholeheartedly thank all of the five speakers for who take out their precious time that on a Friday night for our listeners. Deepika, let me start with you. You run a women-specific finance company. First of all, tell us how did that come to be? Tell us about your personal finance journey. The mistakes that you did and the kind of learnings that you had from there. Yeah.
Hey, thanks, Aditya. Thanks, GST Investments, for having me as a part of this panel with the rest of these amazing speakers who you typically follow on Twitter, but it's nice to be on the same platform as them speaking. I'm going to try and keep this like really short. So I've been in the space of personal finance for 14 years now. Started at probably the worst timing one could have in Jan of 2008, literally when the first financial crisis that we all know of happened. So I was with a wealth management firm for close to a decade. Was with a fintech right after for a brief stint before we actually started Bases, which has been a journey of a little over 2 years now. And if we were to talk about why we started a platform dedicated to financial services for women solely, I think by default we all know this, and there's a ton of debate around it. I'm sure there'll be people even on this platform with very differing opinions. But finance, or personal finance specifically, so has defaulted to men, right? Like it's literally one size fits all men when it comes to financial solutions. So I think what my learnings or experience in wealth management, alongside my learning with fintech, just brought to light how bad the scenario is. And there are self-reported numbers of existing fintech platforms where women investing in capital markets, as per their self-reported numbers, are anywhere between 18 to 22%. And I think these also might be exaggerated numbers, because for the most part those accounts are handled by the men in the house, whether it's a husband, it's a brother, it's a father, right? So very few women are probably taking charge of money on their own. And we also realized soon enough that this problem, and there are lots of efforts happening in the tier 3, tier 4 city space, but nobody's really keeping in mind the fact that there are these urban millennial Gen Z women who are making money, who want to take their decisions but don't know how to, right? And these decisions vary from investments to insurance to other aspects of their financial life as well. So my childhood friend and I, who had just returned from her master's at Wharton, had different problems when she was going for her master's in terms of like getting a loan, etc. So yeah, I think with our strengths, hers in technology, mine in wealth, it just made sense to and the timing was right. It couldn't have gotten better that we launched Basis. Basis is now a platform with over 100,000 women interacting within our community, within our learning, and we are at the anvil of launching financial products. We actually just launching a credit card as well for women, And we could probably talk about that stuff later. But yeah, that's been my journey so far. Lots to do. I'm not going to say lots done, but lots more to do in this space.
So Deepika, if you really had to talk about some of your personal finance mistakes, right? I mean, of course, you did say that you had a lot of. I mean, you and your childhood friend did have some problems finding the money, but specific to you, what are the kind of challenges that you faced in your personal finance journey? And of course, it's a very highly appreciable fact that you guys are focusing just on the women side of finance, right? And so I listened to a lot of your interviews, and I was just shocked last time when you were on CNBC. You said that the kind of participation by women is extremely low. So I would really like to ask you, what are the kind of mistakes that you made, and what would you really suggest fellow women to do, to take charge of their personal finances? Yeah.
So honestly, Aditya, it might sound really silly, but this is literally, I think, the biggest mistake I make. In fact, I keep talking about this to my colleagues who I worked with for 10 years as well. I see Winston here. Winston knows when I was at International Money Matters, we had a couple of interactions there. And I think my biggest mistake, and I regret this thoroughly, is is we've heard this a lot, but I literally mean this, not starting soon enough, right? I started working at 21, and obviously salaries were not amazing back then. There was not as much. I was working in the space very logically. I should have started investing right then, but unfortunately that didn't happen because I don't know, you, it doesn't strike you very obviously that, hey, I'm missing out on this. You know what people are doing wrong with their finances. It's hard to identify what's going wrong with your money. But I actually actively started investing only probably by 25 and 26, right? At which time I thought, okay, 25, 26, my friends are busy spending their money, not really understanding. But now when I look at it like 10 years later, I wish I had started as early as I had, right? And probably that curiosity should have bequeathed much earlier than it did. And I think now when I look at the platform people have to invest now, I'm talking about our traditional investments. I know there's a lot of like investment buzz around crypto and all of that, but even then I see people still making the same mistakes that people like me did back then, right? You've not tapped into traditional investments, you've not explored capital markets, you've not started as early as you could have, and even when you did, you started with stuff you didn't understand, I think. And I'm very proud of this, and again, we'll have differing views on this. I have never invested in a fixed deposit ever. And I think I know Larissa also has some opinions on liquid funds, etc. And I've never done a FD in my life, probably like if for the company, etc. But not in my own personal capacity, right? And even for me now, when I talk about FDs, it's very theoretical. Now I don't know if that's a mistake or not, but it was not something that I thought will ever work for me. Liquid funds work for me, arbitrage funds work for me. That stuff I stuck with and explored, but I really regret not investing in the capital markets earlier, right? And I keep seeing the news. And all the news that we've seen in the last couple of days, the markets have been highly volatile and things like that. But when you've built that discipline as early as you would have and should have, it really doesn't bother you, right? You just go on with your day, you go on with your job, and you actually focus on stuff that matters. So yeah, I really wish I'd started earlier than I did.
Awesome. So thanks a lot, Deepika, for being candid and honest. Not many people would admit to their mistakes, right? So one learning from Deepika, guys, is to start as early as possible. You have the whole periods of compounding in front of you, so use time to your benefit. Uh, Also, a huge shout out to the team at Get Basis. Guys. I've been a part of one of the sessions, and the community that they have is just amazing. The kind of in-depth questions that they ask, and I hope Deepika and team, achieve whatever they plan for. Coming to you, Balaji, you are the CFO of a leading edtech. You practically crunch numbers for a living, right? I personally know about your crazy personal finance journey. So why don't you tell us about it? Tell us everything about it. What did you do? What did you learn from it? And some personal finance hacks, because I always find myself listening to all of these hacks that you tell me. Yeah, please.
Thanks, Aditya, being too kind. So just a quick one here. So I think I beat Deepika to something about, obviously the first thing is not starting to save really early. So while she talked about 25, 26, I started saving and investing at the age of 45. So I'm really, really late into it. So better late than never. So I started really late, and it's just the past 4 years I've been really saving decently well and investing. And in terms of early mistakes and stuff like that, yeah, just about everything in the book I've done. ऐसे बहुत ही कम चीज रहेंगे जो छूट गई रहेगी मेरे से. It could be like, taking a housing loan. So at a very, very low salary base, I over leveraged myself to buy a bigger house. In hindsight, it was a decision कि यार हाथ में saving होते नहीं थे, चलो EMI में लगा लेता हूँ. So this was way back in 2001 when real estate was cheap too. So that actually helped me. Then taking multiple amounts of top ups as the property value appreciated to fund a lot of more other luxuries like a luxury car, be it a vacation, everything. So top ups में fund करके top ups उठाते गया, खर्चे गया. Lived a completely consumption driven life and did all of those mistakes and rotated money on credit cards way back in maybe what 2005 and all, where a lot of things like 0% balance transfer was in vogue for $99. So I just used to love the hack यार एक से दूसरे में transfer करो, and I actually rotated through 5 cards for maybe 18 months and actually furnished my house through that and paid zero interest over it, just processing fees of $99. So that used to give me a high. So talking about hacks, that's one of the things I've done, Aditya. Other than that, never had the courage to build up emergency funds. EMI में पूछा पैसे चले जाते थे. So I said, yeah, let me figure out a way to save it. So what I did was I actually took a top up of 10 lakhs and it costed me around about 8% odd, and I invested it in a FD of around about 6.25%. Not the right thing to do, but at least एक जिगर आ गई कि यार ये पैसे को तो हाथ नहीं लगाऊंगा. And post tax, more or less, I was at a break even kind of thing in terms of interest outflow and inflow. But that's the first time I built in my emergency funds. Never had medical or term insurance because I was working in a very good brand, safely secured and stuff like that. But a death in the family actually woke me up to say that, like, you need a personal term cover also. So did that way back in 2011, insured myself really adequately well and stuff like that. So otherwise, my savings journey started only after my son was born, which is 8 years back, and saving a bit and investing started 4 years back. And I became debt free just about completely 5 years back, and on the second investment out maybe just last year. So I've done most of these mistakes here. That's just it. So that's all I could think of currently. Otherwise, they're happy to add more. Yeah.
Yeah. So, guys, like I said, like I said, folks, it's a very wild journey for Balaji. So he did everything, and now, he's come back, and he's going through the savings and investment route. So, Balaji, what would you suggest to a 18 or a 21-year-old who has just gotten his first salary? What if he's someone like you, who likes to splurge on things? So, what would you suggest to him? What is your one advice to him?
So yeah, my biggest advice is ki, like we tend to oscillate. So I was one end of the pendulum where I was oscillating too much towards spending, and the other end is proper fintwits like me even advising कि यार you should start saving early. I feel the balance is the key. I feel like अगर अगर आप 20 साल की उम्र में 22 साल की उम्र में थोड़ी लाइफ भी जिए नहीं तो फायदा क्या. So the balance is critical in terms of how you spend also, live your life also, and it's okay to make mistakes earlier in that life with your lower salary packages rather than do it much later in life. तो जितना जल्दी जितनी गलतियां कर सको और उससे सीख लो, it's much better. So start early in terms of saving, but get a balance in terms of actually like getting the ideal balance between saving and spending. That's one thing which I'd say, like one needs to start. And with every passing generation you get to learn more. Yeah, at that time when I bought my house, the yields from rent were as high as 5 to 6%, so it did make sense to buy. But if you had to ask me the same question today, one needs to completely live in a variable mode on rentals and stuff like that. So it's okay to save money, live on rental, be flexible in life, and like and save up that money. आज की तारीख में for a youngster maybe in a city like Bombay even to buy a house would be such a difficult task, purely because down payment कितना बचाएगा, हो ही नहीं सकता. I mean, if you want to buy a decent house in a place like Bombay, it's so expensive. So start saving rigorously and stuff. Live life, make mistakes. That's something I can tell to every youngster.
Sure. So, just summing up Balaji's lessons, folks, start early, enjoy life, make mistakes, and yeah, just live life a little. Thank you, Balaji. Shaina, now over to you. Why don't you share your personal finance journey with us? How did you get interested in this topic? Was it some event? And of course, what you learned and what are the kind of mistakes you made? Yeah.
Thank you, Aditya, and thank you so much for having me on this uh, session today with really eminent speakers. And thank you for everyone who has joined today to listen to us and our bits of wisdom. So, after I educated completely in finance, so I'm a master's in economics, and then I'm an MBA in finance, and I'm the perfect example to show that knowledge is not equal to wisdom. So once I joined, once I completed my education, I was a part of a manufacturing concern, and I was heading their operations and finances. But and I have done that for about 12 years, 13 years almost. And in those 13 years, my own net worth or my own personal saving was just a few thousands in in my own saving account, because I would blow away my salary on things that I don't even know where they are, where they're rotting, or on lunches and dinners, and I would spend lavishly. But because the biggest mistake I made was I did not believe in compounding, and I thought that why do we invest? There will always be money, so why do I need to invest? Save for what? Because we're saving for a future where there will be no money. But I think there will always be money. So so big mistake, definitely. Life does not remain the same. There are always uncertainties, and there are always events that bring about drastic changes in your life, uh, where you move from top of the mountain to the bottom very, very quickly. So I started my so as COVID hit, the business hit, and I at that time there are certain personal events that happened, which at that point made me realize that left on my own today, I probably will not be able to survive 2 months. You know, so that's a jolt that I took, and I that's when I really got serious about creating my own corpus. And this was at the age of 35 or even almost 36. So if Deepika thinks she's a late starter, I'm 10 years ahead of her. So that's that's the first mistake, that I did not believe in compounding, and I thought things will always remain the same. So things change, events happen. You have to be prepared. You have to uh, you know plan ahead. Have to be smarter than these uncertainties. So that's my journey. And as COVID hit, FinMedium had started, then I joined them as it started. And that's where I gained a lot of knowledge. And simultaneously I started investing. I started relearning everything that I had learned in my education, everything that I already knew. So I was just scratching the dust off the you know of my brain cells, and recollecting everything. And I already knew about mutual funds, I knew about equities. I was just brushing up my knowledge, seeing what's there at the moment, and started investing. And started investing aggressively, both in mutual funds as well as direct equities. And uh, and at that point I made another mistake, that I got too aggressive, and especially with direct equities, and took a lot of impulsive decisions of either selling too quickly, booking a profit, or holding on to something that was just bought off a tip, or a bought off a news channel thing. But these are mistakes that are actually they're more like learnings, and how you gradually grow. I understood. I took a few courses. I understood fundamental analysis. I'm still understanding fundamental analysis. I'm trying to get deeper into it. And parallelly I'm investing in mutual funds. I also have an asset allocation in place, somewhat in place now, with a bit of it in fixed income funds. So yes, that's a mix that I have made. And another thing that I got rid of was, I took a big trash bag and threw my ego in it. And now I do not hesitate to ask, to consult, to talk about it, to clarify my doubts, because I've fallen in love with learning more and more about all these instruments, about the asset classes, about various whatever I can, through this journey. So yes, that's been my journey.
Wow. Shaina, I must thank you again and congratulate you because you have been extremely honest and candid about your journey, and your and Deepika's example really show us that it's never too late to take finances in your control. And I especially love the last part where you said that you're constantly asking people or learning it yourself, and you're actually curious about finance, right? So I feel that it's one of the requisites to really do well in the financial markets. You should be curious. You should keep researching. You should ask people. It's never bad to ask people for help, right? So yeah, awesome, Shana. Thanks a lot. Shana, last question for you. I was just reading your recent article in Economic Times, and you spoke about discipline when it comes to personal finance. Would you care to elaborate? And what are the kind of frameworks that you are following personally when it comes to your own personal finance? Yeah.
So yes, I mean, I have become disciplined in the sense that so I know exactly what I want to invest every month. So my expenditure comes after what I have decided to save. So if I have to invest I know I have to invest for that. If I have to reduce my expenditure for that month, I would do that. If there are some expenses that have to be postponed to the next month after that, I'll happily do that. So that is a kind of discipline that I have gotten into, and also I've become a little serious about asset allocation. I don't I don't just buy. Investing does not mean just putting in more money in very high beta funds or high risk equities. Nothing like that. It has to be a very stable and a calm journey that you take, and discipline, more and more discipline, by by being very very focused about what you want to invest every month, and then gradually increasing that. So I don't have to now. I don't feel the need to change my phone every time a new model comes in, or no, don't need to buy extra 10 pair of shoes because of whatever reason. But that does not mean that I don't live a life and living it up. I do everything that is needed, but definitely with a discipline, with a focus, and with a goal in mind as to where do I want my corpus to reach by a certain age.
Understood. Thank you, Shaina. Uh, Coming to you, Larissa, you're the senior editor at Morningstar. And guys, I must tell you that, if you haven't really read Larissa's articles, you must really follow her and read all of her articles because she interviews all the senior fund managers. And, her articles are very timely, crisp, and to the point. So, first of all, thanks for that, Larissa. And now, please take us through your personal finance journey, your learnings, your mistakes. Yeah.
Yeah. I think my biggest learning has been the ability to say no. And I'm not saying it only in terms of no, I'm not going to spend money to impress someone, or no, I'm not going to get myself into debt just to have a lifestyle. My ability to say no is say no to something you I will not invest in something because I don't get it. And I think this happened to me when I just started working, and my brother's friend came and told me that she's a agent for LIC and she has this fantastic product that I must invest in. And I really wasn't sure, and she just kept persuading me to do it, and I paid the premium and I did it. And then I told her, you know what, this doesn't suit me at all. I don't need such a I don't need this product. And what really hurt was that she was an extremely rich lady. She did this as a hobby, and she knew it was my first job, and I was really struggling to make ends meet. And I think the lack of ethics in that completely jolted me. And so the first lesson I learned was learn to say no. So when I meet a bank relationship manager and they try to sell me some hybrid insurance product, I always tell myself politely, learn to say no. If a distributor was forcing a thematic fund on me, learn to say no. Learn to say no to stock tips. Learn to say no, I will not buy something just because my father in law, brother in law, sister, and the whole world is buying it. So it's this ability to say no that has really helped me in good stead. Another thing, learn to say no to constant pleas for charity. And I realized this over the past 2 years. I was just giving money to help others without realizing, is it going in the right direction? Is it going to where I want it to go? So, in the end, guard your money because it needs to serve you well. And for it to serve you well, you need to say no. And for me, that has been my biggest learning.
Thank you, Larissa. Definitely, it was a very unique answer, and thank you for that. Coming to you, Gurmeet, I noticed how you combine humor and personal finance investing on your Twitter timeline. In fact, you use a lot of humor to deliver messages on the importance of asset allocation or risk profiling or investing in general. So why don't you take us through your journey, your mistakes, and your learnings, and obviously why? I mean, how did that come to be? Why do you use humor? And yeah, that's about it.
Thanks, Aditya, for having me. I think humor comes naturally to Punjabis, and especially when you're making money, the mistakes you do, unless you have some humor, it can be very stressful. Uh, I come from a very small town. There's this place called Sagar in Madhya Pradesh. I don't know if many of you have heard about it. While the name is Sagar, there is absolutely no water there. काफी बुरा हाल है पानी का वहाँ पे. And I did my I was born brought up there, did my BBA honors from there, and you know how the study standards are. And then I didn't want to join my business, so I requested my father and grandfather to allow me to do MBA, so that it can buy me 2 years more of not joining my family business. And we had a departmental store, but I had good understanding of businesses, because but dad was distributor for Bajaj Electricals, Pidilite, Days Medical, which makes this Kyo Carpin hair oil, Page Industries, right, Pidilite, Dabur. So we had a large distributorship. So I had some idea of how this always had this fascination for FMCG and consumption companies. When I did my MBA, 2002 happened. I passed out in 2002, and you had the IT bubble. So not many companies came to campus, and the first company who came to campus was ACC Cement. And fortunately, that was my day, and I got through there. So I'm essentially a cement guy who then joined HDFC Bank. Because the cement life was boring, and my batchmates were having a good time in banks. And that's where I met Kshitij. Both of us used to sell cement, and then we joined HDFC Bank, and that's when the fascination for personal finance started. So my journey, my biggest mistake, I pinned it on my Twitter line, was when I joined HDFC Bank. We used to get ESOPs, and we were young. I was 24, 25, and I got my first ESOP. Uh, uh, Sorry. And I got an offer from Reliance Mutual Fund. I got a 30% rise. उस जमाने में salary 25-30,000 month की होती थी. 30,000 was a lot of money for if you're a bachelor. And I allowed my ESOPs to I did not vest them. I joined them. I joined thinking that 30% is good enough. And and now when I look back, despite HDFC Bank not performing, and I can see Safir Bhai also there on the call, me and Chit still repent. I think our colleagues who stayed back have, I think, the value today would be worth 18-20 crores. So so that was the first learning, that once you get something which is that is how powerful equity can be. Though I realized my mistake and started buying HDFC Bank shares in 2010, I'm still way off from what it could be. The other mistake, which actually turned to be a blessing, was that since we were in Reliance Mutual Fund, which is Nippon, we always had this pressure of NFOs coming, right? And sometimes there was so much pressure कि अपनी application ही डालनी पड़ती थी. Those were the days, right? Equity culture was picking up, and then 2008 happened. And people, I saw people losing 70%. People used to literally come and cry. There were no online redemptions there, so there used to be long queues outside our office. People wanting to redeem money. I could see people crying and in distress. And that time, Reliance launched a fund called Infrastructure Fund, and there was so much pressure. And Kshitij had this huge target. We were both friends, right? So he pushed me that you have to do some SIPs for me, right? I'm running short of my target, and I did some SIPs in 2008, right? Knowing very well, that this is not the greatest thing to do at that point of time. And then, but fortunately, continued. There was another beautiful product called SIP Insure that time, where used to give you free term insurance along with SIP. It's still there. with few fund houses, and I just continued in it. And when I saw the results in 2012-13, I realized that, although the fund was a thematic one, I made some very serious money there. And that's when I think the serious journey started from there, realizing in 2012. And that's when I started, my quantity goals. Because I figured out that what compounding can do. I saw my colleagues making so much money in HDFC Bank in 9-10 years. That was a golden period for HDFC. It almost became 70-80x in that period. And started. So I fixed up my goals. How much HDFC should I have, how much Infosys should I have. I started with blue chip stocks. I increased my SIP amount, and just kept adding. And when I look back, I think God willing, maybe couple of years more, and I think the passive income will exceed the active income. And then, since I manage client money, there were a lot of learnings, because we used to meet a lot of promoters, a lot of CEOs, CXOs, and that gave us more practical insight, in terms of how businesses are being run. And my one life changing event, I'm stretching a little more, was my visit to Omaha, when I attended the Berkshire AGM. I think, and I thank Kshitij for it, because he made me pay. I was telling him, why will I pay for a ticket to attend, Berkshire AGM? Right? He said it's like a, investment pilgrimage. At 6 o'clock, people queued up in outside the stadium, to hear to two old men, who actually, when they start their presentation. And I must, everyone, if they get a chance, whenever they get a chance, they should attend at least once the Berkshire AGM. And Warren Buffett and Charlie Munger at 90 years, you know they talk about long term investing, right? And there is one slide they have, and the entire thing is on a Q&A, and there's 40,000 people sitting in the stadium. And those two great men are telling their mistakes. The first 2 hours, they revisit the mistakes they have done. And it was so humbling to me, that if this is how, big guys think, like, we get too much distracted by short term noise in the market. Yeah. So that's been one of the biggest life changing events for me.
So thanks a lot, Gurmeet. And if I had to really summarize your journey in one word, I would say it's adventurous. From your days in ACC to what you're doing now, right? And of course, I believe every direct equity investor's dream would be to visit Omaha. So I was just listening to what you were saying, and I was like, oh damn, I need to visit that place once. So thanks a lot. Shaina and Gurmeet, this is a collective question for the both of you. Whenever we invest, right? Of course, the past 2 years have been totally out of the blue. It has been a black swan event. People have just come in the markets, and they have directly invested in stocks. They haven't really done a checklist of sorts for their personal finance. So, according to the both of you, what are some personal finance checklist items that they should tick off on before they start a direct equity investing or a mutual fund investing? Thanks.
Gurmeet, why don't you start and I'll add?
Okay, sure. Okay, so I think there are broad thumb rules. There's no standard formula. As you started saying that personal finance is personal, but I think there are 3-4 thumb rules which has worked for me, and I will draw from what even Larissa said. I think what not to do to me is the starting point, and I think you learn as you progress, and mistakes will happen. The idea is to keep learning. I used to, when I met Bharat Bhai first, who run ASK, and he gave me one figure that if you put a filter of ROC 15%, and there are 6,000 listed companies in India, you'll be left with some 300. So he basically meant that a large part of the investable universe is actually non-investable, right? And I think that was the first learning I got. I thought, you should start with what not to do. And investing is also about avoiding mistakes. Once you avoid mistakes, a lot of the things are taken care of. The second rule is that don't make this a competition of mutual funds are better, stocks are better, PMS is better. I find this debate so overrated. That what happens is that we get carried away seeing multi-bagger stories, right? That each individual is different. I don't think so a lot of people have the ability to understand basic financial information. I don't think so people can analyze what to do with a PE or an ROE or a balance sheet item, or how to evaluate corporate governance and all. So I think they start copying. They start saying, okay, XYZ investor has taken this stock, let me buy this, right? Without understanding that what their risk appetite is. What people say, Rakesh Jhunjhunwala invested in an airline stock. Are Baba, he gets 300 crores dividend from Titan. He can put any money wherever he wants to know what how much money did he put in an airline stock. But people started buying, so I'm just giving an example. I'm just saying that, figure out what suits yourself, right? So if you are a guy who's very busy, you do not understand finance, but you are a good saver, you can save 30-40% of what you earn. You can simply go for index funds, good mutual funds, even give it to a PMS if the corpus is live. Select a good portfolio manager, and some of them are really good, whether it's a Bharat Bhai or a Khemka or a Singhania, or there's so many, right? So you can do that. You can be more in terms of managed money if you have the time. If you can devote few hours every day, you can attend to earning calls, uh, you know read annual reports, do more direct stock. So suit yourself, don't copy anyone. Figure out a formula which works, and keep it simple. you know uh, uh, Third, I think, figure out goals, right? A lot of times, we invest without having anything in mind. I think the starting point should be, why am I buying a stock? For example, when I started buying, some of the stocks, I had a clear goal. I want to have an X quantity of these stocks in next 10-15 years, right? And that's when I started buying, and suddenly, short term price movements became very insignificant for me. Yes, it is unnerving, yeah, when you see your stocks go down, and but you figured out over a period of time that, what you need to do. So these were 3-4 things which I think, you should start. And fourthly, be very very clear that copying somebody's style, just buying basis tips and all, there is no shortcut to success. And a lot of people make this mistake that, this is a place where I'm going to overnight become rich. So there's this saying that, the fastest way to become rich is slowly, right? I think these are 3-4 things. If you get, just keep the basics right, and I think mistakes will happen. That's the part of the learning curve.
So I'll just add a couple of things to this because Gurmeet has explained this beautifully. And so, taking the recent bull run and the recent Black Swan event, uh, the basic thing, as Aditya, you asked, as to what to do before jumping into this whole big ocean of equities and mutual funds, etc., etc. The one thing that we must ensure, and very basic, and people have just fallen on their face this time because they did not have a insurances, and secondly emergency funds. So they just went into this rut of investing, taking a debt and investing, liquidating your FDs and investing, taking money from their parents and investing, not knowing just ये स्टॉक चल रहा है, इस स्टॉक ने मुझे एक महीने में इतना रिटर्न दे दिया, so I'm going to, they just all became such champions. So but when the second wave hit, we saw so many people taking a hit because they did not have the funds, they did not have emergency funds when the extended lockdowns happened, to run their family, to run their expenses. I know well educated entrepreneurs and the freelancer celebrities who actually did not have funds enough to meet their ends day after day, and how they had to shut down offices, shut down, chuck people out, stop paying rents, and do all sorts of things to just manage, basic home expenses. So, first thing is get your term insurance in place, a pure term insurance. If you have dependents, must have a term insurance with a very clear nominee on it. Secondly, a health cover, and a health cover for the entire family, not just you as a main guy here, but the entire family must have an adequate health cover without any frills and riders, etc. Please study the policy that you are taking, study the conditions that it offers, and then just must have a health cover and an emergency fund. And if your insurances are in place, an emergency funds, for me it should be up to 6 to 8 months of the monthly expenses, so 6 to 8 months covered completely, at least, if not more. Why not 12 also, but definitely a minimum of 6 to 8 months. Once this is in place, then you step on to your and understand what you're getting into. So, and if you don't understand, don't be arrogant about it. Just start a simple SIP. Just do an SIP in an index fund and a hybrid fund, which divides your risk a bit. Keep some in liquid or short term or conservative hybrid funds, which have a balance. Everything needn't be in the aggressive equity funds or aggressive equities. That might sound cool, but at the end you have to work. You have to protect your capital also. You cannot just go with that kind of a cool flow and then end up losing your very hard earned capital. So yes, these are some things that I and definitely seek advice. There is no harm in taking financial advice because everybody doesn't know everything. If I am unwell, I will go to a doctor. I would not treat myself and then fall further unwell. So if I need a financial advice, I will go to a financial advisor, professionals. They are very good ones. So take advice. They'll set it up for you, and then and then just be relaxed and focus on your main job. Don't suddenly become you know a bull market champion, a fake one though. So yeah, these are the mistakes that I think one should not do.
So thank you, Shanna and Gurmeet. So just summing it up, folks. Have your insurances in place, have an emergency corpus in place, and just don't be an equity investor for the sake of it. Don't be a Rambo. And like Gurmeet said, if it is not your cup of tea, you can always go through the mutual fund route and seek financial help, like Shanna said. So, folks, we're just going to take some questions which we received before the event. So, I'm just going to read out the question, and I will also tell you to whom it is addressed to. Okay. For Gurmeet, it's a very interesting question. For a 75 years old retired person, how much of total wealth should be in equity?
Yeah, this is a tricky one. So, I had actually a client, and this is a client whom I learned a lot. And at 82, he was like 80% equity, right? So I don't think so. There is a standard formula, but and this question is a little incomplete. So assuming that you are not dependent only on this pot of money, right? If I I'll give two answers to this. If you're not too dependent on this pot of money, the investment can be done as a legacy also, right? So you're doing an investment which can be passed on to the next generation, right? So there it's basis your risk appetite. So if a lot of volatility doesn't bother you, you are okay with, let's say 2-3 years of suboptimal return. And a lot of us underappreciate that markets can also test you with time correction. We are so obsessed with price correction that there are periods when there are no returns which are made, right? And market can grind you down. So assuming that you are okay with some short periods of subpar return, negative return, and if you want to leave a legacy, you can still have a decent proportion in equity, and obviously keep a balance. In India, the good thing is even debt, if managed well, gives you a good yield. Our 10-year bond is also 6.5 to 7%. So it's not that you really miss out by not being in equity. You still, and if you take a 3-year plus kind of a route with indexation and everything, it can become very tax efficient. It may not beat inflation, but you can be still be neck to neck with inflation vis-a-vis traditional deposits. So, but if this is the pot of money you are dependent upon, you're looking at some cash flows out of it, then equity proportion has to be low. A large part of the bucket should go towards fixed income and instruments which give you regular cash flow. So there is a rule, age old rule of finance: 100 minus age should be your equity allocation. But that's only applicable if that's the only pot of money which you are dependent on and you have no other income per se, Aditya.
Sure, Gurmeet. The next question is for Deepika. I hope Deepika is a speaker now. Yes, she is. Okay. So, what should be the ideal emergency fund, even if you have medical insurance? So, I think Shanna did say that for her it was 6 months, but of course, I understand it's very personal. So, Deepika, what's your view on this? Yeah.
So I think typically even like what financial planning practice sort of like defines is 6 months worth of your expenses, right? There are always these differing opinions about 6 months worth of your income or 6 months worth of your fixed expenses, right? But I've noticed this the moment even to me, right? The first time I had to start building my emergency fund, if when I was told, you build 6 months worth of your income, it does sound a little overwhelming, right? So to begin with, I would say 6 months worth of expenses, your fixed expenses, and I'm repeating fixed expenses because I get really funny questions about, oh, what about like my credit card expenses, which are obviously very optional, especially in an emergency, right? But I think in my experience in the last 2 years, where I for the first time had to utilize my emergency funds and did find that the 6 months worth of expenses was not enough while COVID last year. In fact, while the second wave, I had to withdraw those funds and then, in fact, go one step further and withdraw some debt funds as well to just make for those expenses that had come up. I would say, as I would say, anyone in their 30s, especially so, should factor for 9 to 12 months worth of their expenses, because hopefully this scenario doesn't happen again. But if it does, it gets really hard, especially when you really need your own money and trying to scramble and figure out where do I get that money from. And we've heard horrible stories. Aditya, you and I exchange a lot of notes, and we've heard terrible stories about people utilizing their credit cards, not repaying them on time, using credit cards as an emergency source of spending for like actual emergencies, and that really shouldn't be the case. So I would say, like, to begin with, 6 months is a really good place to start. But as you grow older, there are more people at home, more financial responsibility. 9 to 12 months worth of expenses is a really good place to be at.
Thank you, Deepika. The next question is to Balaji. What is the one secret finding that you have identified in the personal finance space?
So secret finding is like, how to clear debt. That my particular thought about clearing debt and stuff like that. I used to aggressively increase my EMIs every year. And other thing which I've done is like, consolidate a lot of debt. So what happens is you have two, three debts, maybe a personal loan, a car loan, and a housing loan. So obviously your other loans are like, at a much higher cost. And since the other personal and car loans are at a much lower tenure, the EMIs are much higher. What really worked for me is consolidating all the EMIs into one lump sum amount and then keeping that same amount and consolidating it with paying with one EMI for a housing loan and clearing off all my other debts at the top up. That really worked very, very well for me with an aggressive increase in my EMI. I hope I was clear there.
Yes, Balaji, that helps the question. Yeah. Shana, I have a question for you next. How do you really plan for retirement when you're not sure of the retirement age? And how should one opt for a deferred annuity product? So how do you opt for a retirement product? Is it like a deferred annuity product or kind of a systematic withdrawal plan?
So Aditya, yes, it's a tricky one when you don't know what. Actually, most of us in our 20s and 30s don't actually know when we would want to retire. Will it be 55, 60, or would we want to continue working till 70, 75? You never know, the kind of work you're doing and if you like that work. So, however, we should plan in a very conservative manner. So if I think that maybe I'm going to retire by 60 or 65, I should plan in such a way that my retirement is going to happen at 50 or 55. So we should plan aggressively towards our retirement corpus. So that is number one. Secondly, so in my 20s, if I the way I plan, so retirement has to be separate. Retirement as an objective or a goal should not be mixed with anything else. Kids education, building a house, etc., etc. All these goals have to be separate, but a goal of retirement has to be uh, absolutely exclusive. So an investment has to go exclusively into that goal. So a monthly SIP, and if you start, and the key here is to start early and start aggressively. That's the only way you will be able to build a sizable retirement corpus whenever you want to retire. So if you're not clear about it, it's okay. So but a ballpark figure that we have, age figure should be around. So we know it's either going to be 60 or 55 or 50, not less than that. And if you have a feeling that it's going to be less than that, then go even more aggressive. And when you invest, you the corpus at the end needed has to, of course, count in inflation. So if I take it very conservatively, inflation of 6 to 8%, that has to be factored in. And then we have to plan a monthly SIP or however you want it, so that a sizable corpus can be reached, which can maintain your cash flows, which can maintain your lifestyle, your house, your health, the medical attention you will need, all of that. And how do you withdraw it? So I think an SWP or a systematic withdrawal plan, as you mentioned, is a beautiful way of withdrawing it. So how it comes from whichever fund to your liquid fund, and and then you can keep withdrawing it. So that's the way it has to be done. And how uh, the funds that we withdraw must come out of our you know longer term investments, obviously, so that we can have the advantage of LTCG in equity funds, and in debt funds they have to be more than 3 years old, which obviously they will be, and we will withdraw them like that, so that we get that indexation benefit on the debt funds. And as far as withdrawing from, so this is I think what you wanted to know with respect to withdrawing systematically and utilizing your retirement corpus.
Thank you, Shaina, for that comprehensive answer. Larissa, we move on to you. Someone is asking you how relevant is it to invest in the international markets along with Indian investments, and what are the kind of instruments that are available to retail investors. And the third part is how efficient are these mutual funds? These are international fund of funds or index funds. Yeah.
Okay, so I'll tell you, when we think of diversification, we always measure it across certain fixed dimensions: assets, stocks, industries, sectors, strategies. But it's very rare that you will find an investor who says, I want to diversify even globally. So, whoever asked that question, I want to say thank you. That's really a good way that diversification is not limited to your border only. And the second thing is, global diversification is not only about all the tech and FANG stocks. There are so many stocks like Home Depot, Starbucks, Coca Cola, Tesla, BlackRock, artificial intelligence, which you can invest abroad, which global investing allows you to do so. For example, going globally, you can get exposure to sectors that are not publicly listed in India. For example, mining stocks. Globally, there are just no shortage of options. You have Sibanye Stillwater in South Africa, Trilogy Metals in Canada, Glencore in Switzerland, BHP in Australia, Rio Tinto London, Whale in Brazil. The thing is, why should you limit yourself to just one country? So I remember Rupal Bansali, when the CIO of Ariel International, she once said, based in Chicago, that she really wanted to invest in a tire company. And she said, if I restricted myself to the US, I would be forced to invest in Goodyear, which actually she didn't think was a great company at all. She's saying they had not invested sufficiently in technology, in R&D, in training their workers. They were very good with the 16-inch tire market, which was commoditized, but that was not where the money was. They could not ramp up to the higher rim size models. And she's saying it was an extremely leveraged company. So she's saying, if I wanted the best tire company in the world, I would go to Michelin in France or Bridgestone in Japan. And that is what global investing is, because good ideas do not have borders. There is tremendous value in diversifying across geographies. So, for example, if Americans, and she, as an American, was talking, their domestic stocks represent 55% of the global market. For Australians, it is 2%. But when it comes to India, we corner just 2.5% of global stock markets. So if we limit our investments only to domestically listed companies, we are curtailing our portfolio's wealth creation potential. So I think it's really, really good that we, like I said, good ideas don't have borders. It's good to invest across the globe, and investing across the globe is not limited only to the US. Because the last decade, of course, the US stock market has been on a crazy run. But then they also have the lost decade, which followed the burst of the tech bubble, when the S&P 500 lagged behind Europe and China. So global investing is really should be on every investor's mind. But Aditya, as to where exactly to invest, I think Gurmeet is a better position to talk on that aspect. I don't think I'm authorized to say where exactly to invest in.
Gurmeet, you want to add something on that? What are the kind of geographies one should look at? Yeah.
Sure. So
And thank you, Larissa, for the beautiful answer. Yeah.
yeah, I think it was a brilliant answer. I think the point she made on, I think also Aditya, the what we don't realize is the correlation, right? Sara focus itna return centric kar diya hai that the risk and correlation takes a backseat. I was seeing 30-40 years S&P 500 correlation with Nifty was just 0.15, right? And so sometimes different economies go through different cycles, right? And that's why this one, and Kshitij has covered a lot of funds internationally in various shows, including Bloomberg It. I think what I do, I can tell you, I think so. One is to make it goal based. A lot of now these days people have plans to send their children abroad, use LRS limits to build corpus gradually. In that case, the percentage of international funds with dollar exposure can go up, and then you can do both fixed income REITs and equity, if that is the objective of let's say having a offshore asset or sending your children overseas for higher education, because it's a very expensive affair. But in case there is no such goal, maybe 5-10% of the allocation should go there. I personally think passive is a better way to do that. We don't understand international markets as well, so we should participate for diversification and not just chasing alpha there. So I personally do S&P 500 and Nasdaq. It's largely US, and I'm thinking of now doing something in China, because Chinese market is going through some rough times, so maybe it will last a little longer. But my essentially has been two ETFs, which is S&P 500 and Nasdaq. And I was actually having a chat sometime with Chitej, and we figured out that last 5 years and 10-year returns in Nasdaq, despite this year it being down 15%, is still 25% CAGR, right? So that's why I keep saying this entire discussion of generating alpha, beating the benchmark and all, I find it very overrated. I think as long as my objective is being met, which is low correlation, diversification, getting some decent return, I'm okay. I mean, I'm okay even in mirroring the index.
Thank you, Gurmeet. So, guys, in the interest of time, we are just going to ask each one of you for one personal finance tip or a hack, right? And let me start with you, Gurmeet. And I would request all the five speakers to tell something different. Whosoever does not tell something different has to treat me. So, yeah, starting with Gurmeet. Yeah.
So I think the first hack is not to try anything different. I think that will help you avoid a lot of mistakes. And I think I just draw back on that previous. I think the goal should not be retirement. It should be financial independence. So we have a lot of people who are, I can see on listeners like FI, Kshitij is being there. I can see probably a lot of them may not want to retire, but they are still, a lot of us are still financially progressing towards financial independence. Retirement, I mean, is a word which can sometimes also mentally put you off in your planning, because that actually means ki 60 years mein main karunga. A lot of friends I speak to, young generation I speak to, wo bolta hai, sir itna paisa 60 mein karenge kya? I will not have the what is the fun of doing biking or going to Europe when I'm 60, right? So I think we should focus on financial independence, which means, as I said, you are not dependent on working just to sustain your lifestyle. You are working for the passion of it, right? So I think that's one thing you should do differently. Think of making yourself not dependent on the job or the work you do. If that is the goal, a lot of this volatility, a lot of these events, a lot of these things will sound short term noise. Secondly, apply the same logic on equities what you do with other asset class. We don't get up in the morning and check the gold prices, right? कि मैं खन्ना ज्वेलर फोन करूं, चेक करूं मेरे घर की ज्वेलरी आज कितने की हो गई है. We don't get up in the morning and check our house prices, right? I will call, oh, my house price has gone from 10,000 square feet to 8,000. Let me sell my house and move into rent. We don't do that, right? We buy more when we get our favorite brands on sale, right? So unfortunately, in equity, we confuse price performance with business performance. Let's start avoiding doing that. Once you start applying, it's not easy. It's easier said than done. A lot of things will change.
Thank you, Gurmeet. Larissa, what about you?
Okay, I would say that the smart thing everyone should do is figure out which investment you must practice continuity and in which investment must you have an exit strategy. So I'll give you three quick examples. I remember my first investment was in a Zurich mutual fund, which was later bought over by HDFC. And when I was talking to Prashant Jain later, a few years ago actually, I told him, Prashant, when you were in Zurich and I invested in your fund, I was really excited. And when HDFC bought it over, I was really upset. But when I heard you moved with the entire team, I was really happy. And then he said to me, I hope you still have the fund. And I didn't have the fund. And I felt so embarrassed. So I said, yes, of course I have the fund. But it got me thinking, why the hell did I sell the fund? I would have made a killing. And I don't even know why I sold it. And the second mistake I made was with Pigeon Jennison Global Opportunities. I bought when the market hit rock bottom on March 2020. So within 6 months, I got a 72% return. And I exited. If I had stayed on, I would have made so much more money. And the third was a tactical bet I took in SBI Pharma in 2018. And I had everybody mock me and said, oh, pharma's going even worse. It's in the doldrums. And I didn't care. I really didn't care. And when pharma really rallied, I didn't know whether to sell. And that is my biggest mistake. I still screw up. When do you decide how to let compounding go on, manage the continuity, and when must I have an exit strategy? So generally, you have an exit strategy when you have a, a tactical bet, right? I'm going into pharma, I'm going into tech. Otherwise, you let your winners run. So when continuity is broken, that compounding is hindered and you lose. So I've still not made peace with where I draw the balance. And once you get that, that's a big thing. That's a good hack to have. Know when to exit your strategy and know when to let the winner run. I'm
Thank you,
done.
Larissa. Balaji, you?
Sure. So one thing I'd like to add is like, when you look at retirement goals, the standard formula talked about is like, you plan for 25 years of your annual expenses. I feel like, the biggest mistake we do is at every stage in life, as we grow up and stuff like that, a lot of lifestyle expenses creep in, which you usually won't do during retirement, like restaurants and stuff like that. So in every phase, you have that. When you're between 25 to 35, you have a different set of needs or wants, rather. And then as you grow up more of restaurants, you can't party the same way you did maybe at 45 the way you did at 25. So when you have a peak expenditure of what you're actually expending out and stuff like that, and if you baseline that towards your retirement, you're actually stretching too far for the actual amount of time you need to work. So get it right in terms of what is actually what you need to save for and figure out your retirement goals. So that's something which really works well. And what I do for that is track my expenses to a T. So Excel really helps very well. So that works very well for me.
Sure, Balaji. Thank you. Deepika, what about you?
So I'm not going to give any investing advice. I just have a very quick tip which I realized worked really well for me. I think we all do spend, right, in whatever format. Once we've budgeted, once we figured out like our financial plan, etc., we do have regular expenses. And one thing that worked for me, and I think I only realized that how amazingly it can work in 2021 is using smart credit cards, right, and using your credit well, if you can. I literally, it may be a good or a bad thing, I literally use my credit card like a debit card. The expenses that I would otherwise put there, I put it on my credit card. And for the most part of 2021, whenever I could travel, our usual travel expenses, which are huge, I could like offset most of the ticket expenses, some of the like accommodation expenses, etc., on reward points, right? You don't realize you spend a lot. You do spend even when you have these regular expenses. Why not make better use of them, right? If we are prudent people, if we manage our money well, so like make your money work harder for you other than investments. This is also one way of managing it a lot better.
Completely agree with you on that one, Deepika. Credit cards is a major pet peeve for me also. I live life for reward points. Yeah. Thanks.
Actually, Balaji, I was surprised that you did not really talk about the credit card point because I was expecting you would say that. So yeah, thanks, Deepika, for adding. Yeah. Lastly, Shaina, you, what's your one personal finance tip? Yeah, to every one of us.
So mine is very simple, and it's it is to learn more and more, because and not be afraid of an economic times or any pink colored papers that come to your house in the morning. Please educate yourself. So somebody, a very proficient personal finance writer once said that money is something you will need till the last day of your life. It might sound shallow, but it is true. And even to live another day, you definitely need money. So please educate yourself on how best to make your money work for you. You know, and don't be hesitant to learn. Don't say ye mere ko samajh mein nahi aata hai, ya ye mere bas ka nahi hai. It is simple if you get on to it. You don't have to learn ratios and the sortinos and alphas and betas. Have the basic understanding of asset allocation, have the basic understanding of where you want to reach, and have the basic understanding of the basic instruments that exist in the market, and your insurances, and things like emergency funds. That process of learning should continue. Don't stop, and don't rely on television hosts early morning to give you your financial advice. Dig deeper, learn yourself. That is something that is going to stay with you for a very long time and help you through thick and thin. So that's my two words of wisdom for you.
Thank you, Shaina. So, guys, with that, we're going to end the session. I believe this was truly a personal finance masterclass with the five of our speakers coming from different backgrounds, making different mistakes, and sharing different learnings. Again,
Yeah,
thanking all of them.
Aditya,
Yeah,
one minute. I need to add something before you close.
sure, sure, sure.
Guys, huge round of applause to Aditya and Team JST. One thing which keeps me very excited for asset management industry is that, a lot of the young advisors, intermediaries think very differently. A lot of us are, we're not technically, competitors, but a lot of us are competitors. To bring people from different forums together, and there are people from AMC I can see who are listeners. I can see Aditya, his mentor, is also there in the listeners. I think needs a very open mindset. And I used to tell this to Aditya, because he's much younger than me. I see so much promise in him. And if you have advisors of this quality, it's easy to do a space session on 5 stock ideas which will become multi-baggers, right? So what you're doing on a Friday is taking through a personal finance masterclass, getting back to basics, how you should do the basics well. So huge shout out to you. God bless you and the entire team there, Aditya.
Thanks a lot,
Absolutely,
Gomez.
absolutely. Very, very well done, Aditya. And really, really a wonderful masterclass. And really, you're doing wonderfully well in this space. And your IPO research is what I'm a complete fan of. So yeah, shout out to you for that as well.
Thanks a lot, folks. Thanks a lot, folks. Guys, stay tuned for more of these spaces. I will try to get more of my friends on these spaces. And truly, guys, I learned a lot from from your mistakes and your journeys. So thanks a lot for imparting your wisdom. Good night, guys. Have a great weekend.